Um, I'm sorry. We are thrilled to have you all here for what promises to be an insightful and interactive evening which focuses on entrepreneurship, sustainable venture building, and understanding venture capital firms. So, the Hult Prize, as you all know, is a global initiative which challenges us students to create a for-profit startups which focuses on at least one UN Sustainable Development Goal. And it's not just a competition, it's a movement where ideas evolve into impact and where students like us become impact makers. And today we have with us someone who has helped countless startups turn ideas into successful ventures, co-founder and managing partner at Blume Ventures, one of India's leading early stage venture capital firms. Mr. Reddy has been instrumental in backing some of India's most exciting startups, including several of them focused on sustainability. And he also shares his deep insights on venture capital through his YouTube series. Please join me in inviting Mr. Karthik Reddy to stay.
So welcome everyone. Your team has been insistent that I come and present. I hope this is worth your evening time. I know you've had probably a rough week, 4 days of the week gone, and a full day of classes. So here we are at 6 p.m. on Thursday. Hopefully it'll be well worth your Thursday evening. Do we have all of the participants, or you want me to wait any longer? We're all good? We'll start? Cool. Okay, and thanks for accommodating my time. I know I pushed him a lot to say we'll start at 6 and we'll wrap as quickly as possible. Leave more time for like Q&A. I'll just run through the slides. And then you'll get an idea of what we do, what we think of, both how does our sustainable portfolio look like from the context of the Hult Prize, and is that something that we have chased? No, but like we do. In fact, a lot of people ask us, are we an impact fund? And we don't classify ourselves as an impact fund. We are a general purpose tech fund. But as rightly pointed out, we end up finding in every cycle of investing, which is usually a 3-year cycle. Every time we raise a fund, we use the money to build a portfolio for about 3.5 years. We invariably find ourselves with 20, 30, 40% of our portfolio looking like an impact fund, right? And so there'll be a lot of relevance in our portfolio. You can go and mine that later. So I'm one of the co-founders. So this is the backstory of Blume. So Sanjay and me started it in 2010. We just completed like 15 years from the date the Blume was incorporated, which was October 2010. And early next year is when we theoretically complete like our 15th birthday. Every year we do an annual event in the first quarter, which is like our birthday celebration. So yeah, domestic money. We've turned institutional after all these years. The first time when we went to raise money, no institution wanted to touch a first-time fund manager. So they essentially, we had to go to HNIs and we had to go to family offices, literally door by door. We pitched 600 people, 75 people said yes. We raised a 100 crore fund. Took us 18 months to raise that first fund. Hopefully I'll know by the end of this decade whether all of that journey was well worth it. As much as we get laurels for having raised funds, the reality is people only care what the IRR is and how much money you've returned. So we're still at it. I won't say we've arrived, but like we're trying hard. So we focus both on domestic and technology. So when I say domestic, the founders could be from India but building for the world. So we're big fans of the idea that Indian founders can build for global markets, and that's a theme where almost 40% of our investments are done. We tend to be sector agnostic, but that said, we won't do capital intensive, infrastructure intensive, people intensive plays at seed or pre-series A because that's not a moat. We don't have deep capital pockets, so fundamentally we're looking at ideas that can scale, usually with technology as a moat, and that's kind of been our go-to. So we've done fintech, agri, gaming, media, HR, all of these things. I think these are the sectors that have most of the impact things tucked in: fintech, agri, some people and skilling, EV and mobility, healthcare, education, right? So there's enough sectors, that's what I mean. Like when you look at the spread of investments you can make in this country, and you look at the size of this country, any of those sectors executed well, you can build a very large, impactful company. We started with $20 million 15 years ago. Second fund was 60, third fund was 102, fourth fund was 290. So suddenly we grew up, we became very institutional in 2021, 22. You add all of those numbers up, it's only 475. So where's the 650 coming from? We also raised what are called opportunity funds, which allow us to play deeper into our winners. And then we also raised what are called continuity funds. Too much education for this class, but basically, if the life of the fund is over, the original investors want some of their money back. But we think there's a lot of upside in those companies, and we find new investors to buy those positions out, and we continue to manage those under what's called a continuity vehicle. So you add that up and the opportunity funds, and we have another 175 under management. That is the 650. We used to write as small as 250K checks in that first fund. Then this became 500 to 3 million. Obviously, the slide is dated, but 500 to 3 million till, let's say, the last fund. Now, essentially, we're trying to find our place in the ecosystem. We're becoming also a little, relatively speaking, a little bit more risk averse and lazy. When you have a large fund, you don't want to take 500K bets, right? As appealing as they might look, there's just a lot of discovery and baby steps to be done by the founders. We can afford to wait a year or two, pay up 3 times the price at 3 times the valuation, and still get the same ownership, right? So instead of playing 500K at 3 million and picking up 16%, I can play 1.5 at 9 million and pick up 16%. So that's the new Blume, right? So I can afford to be a little bit more lazy. My check writing range has moved to more like 1.5 to 5 million. This happened after we raised 290. I couldn't have done this when I had 100 million or 60 million. So that's how funds evolve. If you saw the press, I didn't design it for my class today with you folks or my lecture, but we just announced the first close of our fifth fund, which is 175 million. We'll probably end up at 250 to 275. This has become our new playbook. This is the new Blume. Basically, we don't have to do the hard work that we did 15 years ago. Why? Thankfully, I think we've inspired a whole generation of micro VCs. If you came and met us in October of 2015, how many micro VCs of sub $50, $60 million fund sizes existed in the country? Any guesses? All of you were kids, but basically, any guesses? How many do you think there were?
Around 5, 10. Yeah, less than 10.
Yeah. Both of them are right. There were about 8 or 9. Even if you stretch that definition in imagination, there were probably 10, 11. How many do you think there are now in 2026, 2025? Close to 200. That's the right answer. 175 to 200 micro VCs. Right? There's every month there's 1, 2, 3 born. Right? Because there's not somebody your age, but someone who's actually put in 5, 10 years in the industry or in a startup or has made money or is from a family office or is from a corporate and basically says, hey, this is like a great space, we should also fund innovation. Let's go set up a 5, 10, 15, 20, 30, 40, $50 million fund and let's become sector specific. Somebody does deep tech like Special Invest, somebody does consumer like Sauce VC, somebody does fintech, and so on and so forth, right? And so it's fantastic to see. If you'd asked me my wildest dreams in 2015 October, would there be 175, 200 of these within 10 years? I would have said no chance, but it's happening. Therefore, I don't have to compete with them. I have to wait for them to curate, pick, and find first-time founders much like yourselves. Like in campus now, you have campus fund, you have grad capital, you can pitch to them Hult Prize, whatever. There's so many sources of early stage risk capital that I don't have to take that risk. I can wait for that to evolve, and therefore wait, pay the price, and pay the later check, right? So, yeah. So Fund 5 is now on. From your these are some of the early sort of stars that are emerging from Fund 4. We've already announced our first 5, 6 investments on Fund 5. Our team has grown like crazy. Even 5 years ago, we were like 20 people, now we're 60. These are our locations, and these are some of our biggest companies on paper, I would say. We haven't cashed out on all of them, but basically we hope that these will become our big companies. Sustainability. So, sustainability, everybody has a different definition. I'm not going to necessarily say I prescribe perfectly to the Hult Prize definition of it. I believe what is impact, ESG, sustainability as my belief system. I also maintain with a lot of international investors and impact investors that 90% of what you do in India is impact. Right? It just changes trajectories on many levels. If you're betting on a deep tech company in robotics that's only selling overseas, so what? You're actually propagating deep tech knowledge, skills, commercialization at a scale that nobody ever did. Right? It always used to be at lab level, and now you're building like a fantastic company out of India. What's the problem with that? So our belief is that, whereas people have very strict definitions. Oh, if it doesn't serve a Indian rural farmer, it's not sustainable. It's not deep tech, which rather not impact, right? And so these definitions I have problems with. But broadly, yeah, some of these, as you can see, are energy transition like ARIM and solar, Yulu, battery smart, oiler, Vecmocon are all electric vehicle sort of mobility ecosystem. Carbon Green was carbon capture. We did this 15 years ago, 14 years ago. So we've been investing all through. We've done stuff in agri-robotics. We've done stuff in agri-financing. We've done stuff in agri-supply chain. We've done education at primary schools, skilling. We've done stuff in healthcare, which is remote ECG monitoring in TRICOG, diabetes monitoring. So there's no, and of course we'll do also the sexy stuff like, you know, ultra-human rings, which are a global product. It's an expensive product. It's $350, so it's not like impact in that sense. It's a rich person's product, but we'll do whatever we think is innovative and which has a global access. So yeah, a lot of you grew up around, I'm sure, some entrepreneur, right? Like, so your neighborhood shopkeeper is an entrepreneur, the neighborhood manufacturing guy is an entrepreneur, the guy who runs the laundromat is the entrepreneur, the guy who does the Thelawala is an entrepreneur, right? So firstly, I want you to understand the difference between the entrepreneur versus what a venture capitalist can back, right? So one of the things we try to drill into our team is that don't ever disrespect an entrepreneur as almost a primary facet of Blume. As a cultural facet, everybody who's an entrepreneur is working their butt off. They might be at different scales of entrepreneurship, but that does not mean that is within their means, within their education, they're executing. That does not mean you disrespect it, right? So step 2. So we get 4,000 pitches a year, right? Are all of them venture fundable? Absolutely not, right? Either a combination of education, lack of knowledge of the market, inability to pick a team, they just look outright bad, right? Second is, when you come to a VC fund, the VC value chain is set up very, very differently from simply providing capital. Most people think we are a source of equity capital like a bank. We are not, right? We're fundamentally playing for, whether you like it or not, and just to throw a number out there, that's why the unicorn tag became like a common parlance in 2013. There was nothing called unicorn, by the way, in the venture world till 2013. It was coined in 2013 by Eileen Lee of Cowboy Ventures in the US. And suddenly it became a popular word. And when she coined it, there were only 14 companies in the private space greater than $1 billion in valuation. 12 years ago. Today there are about 1,200 of this, or 1,400 of these. So it's grown 100x, right? So what happened was venture essentially got stuck on or inebriated on more capital. And when you raise more capital, you need larger outcomes to justify raising more capital, to return that kind of capital. So I'm a $250 million fund. I have to return close to $1 billion. I have to draw down the capital over 5 years, return it by the 12th year. So if you do the cash flow of when I draw down as negative cash flows, outflows, and to the investor inflows over the 5th, 6th, 7th, 8th, 9th, 10th year, 12th year, and you run an XIRR formula, to be able to generate close to 25% IRR, I at least have to deliver 4x. That's $1 billion from just into my pocket. On average, if I own 8 to 10% of the company at exit, because I own about 15%, each company has to, even if it's $1 billion company, I only make about 100 million for myself. I have to have 8 to 10 such outcomes to make $1 billion. The market cap of the companies I have funded alone has to cross $10 billion. I would say, yeah, that's possible. Lenskart's going to list at $8-10 billion. It's possible. It's not impossible. But are you building the next lens car? If you're not, then I'm not interested in funding you. Right? And so that's the idea. So if you don't build with the ambition of that kind of scale and at that speed, by the way, lens car is about 15 years old, but I'm saying if you don't build with speed and that scale, then I'm not interested. So fundamentally, VCs are looking for hot trends, big shifts in technology, regulation, something that changes adoption, right? So there would be a crypto wave, then there will be a quick commerce wave, then there'll be a EV wave, there will be an AI wave. Why? Because adoption tends to be accelerated. And the smartest entrepreneurs will get the money fastest. They will raise most amount of capital. They will accelerate their path to be able to build those businesses. And therefore, you'll create billion-dollar companies much faster than in the normal world. If you're a vada pav chain, which there are vada pav chains, by the way, like Jumbo King, it will take much longer to build it. Right? So it's not, by the way, even QSRs get funded by VC nowadays. Right? But what is the bet now compared to the vada pav chain of 2000? That now you will scale at 100x the speed. Where does that comfort come from? Because somebody has sat inside of Rebel Foods, worked on scaling Fasos to 100 outlets. And so somebody comes out of Fasos and says, hey, I scaled it at 100x the speed. I think I can do that at half the time and twice the scale. See, that's the guy I want to back. So let's give this guy the ability to do 200 vada pav outlets in 5 years. And that's how venture capital propagates itself. So consumer can get venture capital, deep tech can get venture capital, fintech can get venture capital, and therefore all of us are chasing that dream, right? So, but fundamentally, what has that meant? The role models have changed, right? As much as people say Bharti Mittal is great, Mukesh Ambani is great. That's not the role model. The role models changed to Piyush Bansal, to Abhiraj Bal of Urban Company. So these are like the personas of role models today, right? You have guys like Adit Palecha who got out of Stanford and built Zepto, and he's all of 23 years old. So he's here. So you know who these people are, right? Like, so there are different personas for different role models out here. So that's, and therefore you can choose to be that. You don't have to necessarily, I think, you don't have to get into this mode where you're romanticizing role models. Not everybody is a Mark Zuckerberg or an Adit Palecha, right? There are also guys who start at 50 and build billion-dollar companies. So, there's no hurry to get to that mad chase, but if you have an entrepreneurial gene, yeah, as a youngster, you have much lesser to lose. You should shoot for the moon and you should try. We have about 3-4 deep tech startups where the founders have never worked a day in their life for anybody else. Grey Orange, Carbon Clean, Pixel, these are all college startups, right? All on paper valued close to $500 million. They never worked for anybody else, right? So if you have the courage, you should do it. Yeah, there's a lot of learning. There's less fear of losing anything because you have very little to lose. Yeah, so why do you go down the entrepreneurial journey? There's nothing new out here. I'll leave this more to Q&A. I don't want to harp on this. Yeah, and we obsess about this. So almost all my pitch discussions start with the founder saying, why are you doing this? What are you trying to solve, right? And if somebody's trying to chase a sexy problem for the sake of, we typically walk away. If there's a discontinuity in the market and you're actually saying, I know how to tap into this discontinuity and build something phenomenal like AI, that's okay, that's still okay. But it shouldn't be for the sake of building something in AI. It's about what end customer problem are you solving, right? And so if you're not obsessed about the end customer problem, right, you just get tired. This is what we've seen. After the Blume check, if nobody else gives you money for 2 years, you'll just walk away and give up on the idea. Because you never had a problem to solve. You just thought you were building something cool and sexy, right? So if you're not obsessed, so my favorite thing that I picked up over my 15-year career as a VC is that if you're not pathologically obsessed about a problem, I'm not interested in the journey, right? And sadly, a lot of amateur entrepreneurs will come and be overly obsessed about the solution. Actually don't care what you're building. I want to hear from the customer that that's what they want. The two are not the same usually. So most people who pitch us at seed and you meet them 2 years later, the product is entirely different. And that includes, if you go and listen to some of the episodes we put out on the podcast, I always start from the beginning of the journey. The original product looks always different from what eventually turned out at the end. The vision stays the same.
At seed.
No, what they pitch at seed never stays constant. Like if you look at the Lenskart was just a horizontal e-com play doing bags, watches, and eyewear, right?
Yeah.
But then, when he was questioned by his investors, the story goes, because it's flavor of the week and their IPO opens day after. When he was questioned by the investor, what are you doing this for? He says, no, I have this vision that, and maybe he built the story in his head later, but the reality was, he did give up on everything else, so I believe it. He gave up on 80% of his revenue and focused, because the other two categories were doing 80% of the revenue, and only stuck to eyewear, because his vision to start this was because he wanted to build an eyewear brand.
Right.
And he thought India has a huge sight problem, never-ending freaking audience and population, which is always going to be true. And I want to solve for them and build affordable glasses and eyewear for them, right? And then they said, why are you building the other two stuff? I said, no, because there was pressure to build more revenue and GMV. He said, but that's not the reason to build a business. And then he goes back and abandons the other two, gives up 80% of his revenue, and starts afresh with a 2 crore base instead of a 20 crore base. And today you have Lenskart, 70,000 crores of market value. And it's obsession at a different level. Some of the plants he's putting up in Rajasthan, Gurgaon, wherever he's putting them up, are arguably the biggest eyewear plants in the world, even bigger than what you get in China. That's the scale to which you back-end engineer something if you're obsessed about the problem. As opposed to, oh, it's cool to sell bags also, let me sell bags. That's my point. Okay. Nothing new again here. I'm not going to spend on commonsensical stuff, spend time. This is something not new stuff to you, but broadly we have a framework where if you ask me, mota as they say in Bombay, 40% of the weightage of it's not like we put it into a formula and it spits out a score and we fund the company, but it allows a framework to assess a company and a founder and an idea. So 40% of the weightage I would say is on the founder and team. 40% is on the market opportunity. And 20% is to have a realistic view on who's going to cut the check after you. Right? You have to have an idea of the venture market itself. Because if nobody is giving the money after you, with you and your conviction and the founder's belief, you're not going to be able to build a large public company, or a large end-state company, or a billion-dollar company. So if you're swimming against the tide, you better be doubly sure, right? So founders now are distinctly falling into two buckets, and they're very different personas. Somebody who's a second-time founder or a seasoned founder, you have a lot more referenceability. Who worked with them? Which investor worked with them? What kind of exit did they have? And so you actually give them a benefit of doubt if they all check out very well, and essentially pay twice the price, give them twice the money for the same plan. Says one of you pitch me the plan and a second-time founder pitch me the plan, 1 hour apart. Most likely they'll get double the money at double the valuation. Because they're de-risked on various counts. They've done a 5-year journey, 7-year journey. They built a team of 300 people. They might have gone to zero, by the way, but they might still they've still learned a lot, right? Somebody might have built to 100 million. Somebody might have gone to zero, but they actually went through a 5-7 year journey. The premiums you pay will be different for the two buckets. So that's the second-time founder. First-time founders are folks like you, and folks like worked for 5 years in Ola or urban company and is skipping out. They've learned a lot. So somewhere between these two is the first-time founder who's actually worked and built something of substantial scale inside of one of India's unicorns, right? And so they actually bring a very different persona as well. They product managed, they run a team of 50 people, they built a category of 200 million. We literally have founders who've opened 25 cities for Uber, for Ola. So this is like entrepreneurship learned on somebody else's time and time, right? So you get those kind of founders somewhere in between. So you double click on their backgrounds, their like how well fleshed the team is. Second-time founders tend to be solo sometimes. First-time founders always over-index on team. They don't know what they don't know. You back somebody, the person has to act. They can't act. Very difficult for someone to act as CEO, CTO, COO, CRO, CBO, all of that in a 5-year journey. So you have to divide and conquer. If you don't have, team members who can take that load and the pressure and all of that, it's unlikely that very low odds that you'll have one person. Even Zuckerberg had, people he kicked out, but he had, Eduardo Saverin, and he had a bunch of other people as well. Okay? Market, most important, right? So venture will not back something which is a niche market. Okay, so if you're building, just to be trivial about it, if you're building the most sophisticated gas lighter for a start, right? Best product, best design, right? This is the the gold standard in this, right? Is it possible somebody will fund it? Yeah, it is possible, but it's highly unlikely, right? Because why? It's a small value product. Margins are fixed. You can't be building the gold standard and have very high margins unless you've gotten through some technology breakthrough on how to create a spark or a fire. And distribution is a pain for that price point, right? That said, just to be the other side of it and be absurd, Pan Masala, Gutka and BD do very, very well. Right? They're all small products, high margin, small ticket, get great distribution, and they throw out cash like nothing else. Right? So there could be examples of this. You have to believe in that. Right? Would you bet on something of that nature? But you have to believe that the market will be multi-billion, because you only get a small percentage of that, and you still have to be a very large company. So market becomes one of the key elements of why we fund something. And venture landscape is simply, do you think anyone's going to back this post our check? And whatever questions I'm asking, the next investor will ask 2 times the number of questions and will require twice the conviction, because they're playing at twice the valuation with twice the dollars. If I wrote a $2 million check, they're probably writing a $5 million check. If I entered a 20 million valuation, they're probably entering a 50 million valuation. So their belief that this will become $1 billion has to be even higher. And so you broadly, over a period of time, when you do this for 15 years, you know exactly what Elevation is looking for, what Axel is looking for, what Bessemer is looking for. And therefore you have a pulse on who will bet on a company like this, and you try to forward think on whether you want to back a company like this. A lot of the time, unfortunately or fortunately, those biases itself distract you. You say, oh, no one's going to touch this. Actually, look at the IC notes or the IC votes, which one of my partners might have written. He'll say, no one's going to fund this after us. It's too exotic, or it's going to take 4 years to get to the next stage. It's too little money. And so all these considerations matter. Right? That's why a lot of deep tech stuff in India doesn't take off, because there's just a fear of how long it's going to take and whether you can actually build something which is $100 million, $200 million of revenue in 10, 12 years. We have a kick-ass company in Bangalore called Ethereal Machines, does 5-axis CNC machining. Nobody touched it for 5 years because nobody believed you can build the world's most cost-efficient, most sophisticated CNC machine out of Bangalore. So until they actually built a working prototype and actually spat out products at like high precision with, within the tolerance limits that every customer was willing to give them, nobody wanted to back them. So until we had 5-6 machines in production, it didn't happen. Stabilizing that machine took 2-3 years. Because you don't have money like in the West where somebody would have thrown $5 million at that problem. We built that with 5 crores. Right? And so on and so forth. There are many such examples. So, yep, this is what I wanted to cover. I can do your mock stuff, and we should make it more fun and do Q&A rather than me going on with boring stuff. I can address a lot of your points. Yeah, all yours. You want a mic? Is there a second mic? If somebody wants to pass on a mic. Otherwise, stand up and speak. That way everyone in the class can hear you.
You mentioned that as an entrepreneur, you can be obsessed with a problem.
Yeah.
Solving. Isn't there a class of company that start because the entrepreneur has noticed that technology in that field has matured to an extent that you don't have a replacement of existing stuff. For example, BYD or Apple coming out with the iPod. Or there's groundbreaking research which has happened like ChatGPT. So Where does that fit into?
So if you go back to, that's what I'm saying, you're assuming that they haven't obsessed about the problem. Why are you assuming that? The guy who built BYD, why is your starting assumption that he didn't obsess about that problem? You think he built it because there was a battery transition technology that was happening, or did he build it because he wanted to build the best electric car and he was dreaming about cars, or he's obsessed about cars? You know, I don't know his backstory, I'm just saying, right? Same thing with Sam Altman. Along the way, he would have picked up this obsession around AGI somewhere along the way and believed in the mission of AGI to set up as a foundation. It turned private 2 days back, right? Set up as a foundation primarily because there was no proof point that this is actually a sustainable technology, right? So now if you're telling me that's why he built it, no, he didn't build it. He actually had a mission which is far bigger than whether this will become a company or whether it will become $500 billion in private or whether it will actually solve problems. He actually was in the pursuit of AGI. So I think those are fallacious, arguments. Only because I don't know the story. Very rarely will can you make a quick buck? Of course you can make a quick buck. Sorry, don't get me wrong. So if there is a gold rush, of course there'll be people who make money in the gold rush. Your question, is there a crime in making money in the gold rush? No, I didn't say that. Will I fund the people who go after a gold rush? I will. So please understand all the differences. That's all. I'm not interested in people who say, oh, there's a gold rush in California, let's all take a train and bus and start running there. And you say, Karthik, so many guys are running, why don't you fund a few of them? I say, I'm not interested. That's all. No crime at all, by the way. Huh? You make whatever money you want. I'm not interested in that journey. That's all.
I had a question. Basically, you said that there's a wave of technology or obsession in the VC space. So, but for example, somebody's building in a space where there's no obsession and it's a very normal category, a big TAM, but still very a normal category.
Give examples, no? They'll have fun.
Okay, sure. So, like, I was thinking of baby care category. So, like, there's no very simple, transparent brand yet. Like, in beauty care, they came brands like Minimalist, Dot and Key, but there's no brand in baby care still. So, if somebody's building there, but it's not a very hot space, so would they get a VC fund and what can they do?
Historically, no, but now more and more of that is happening, no? So even like Purple struggled for like the first 5-7 years because they were not innovating; they were just a marketplace. Then they realized that if they don't build their own brands, no one will care about giving value. So the first round of them were Nykaa, Purple, etc. The next round was like Sugar, Minimalist, Mama Earth, etc. Because they thought there's a gap in the market and they built towards that. And then Mama Earth was the fastest IPO, by the way, in all of Indian venture history in the last 20 years. So where's the debate? Of course, the people will fund. Now, if you tell in baby care, there is a large enough market because India continues to be a young country. It will keep having a lot more babies than any other country in the world, which is true. We just have sheer numbers. And we think it's a consumption class and there's a lot more consumption power. We're making that storyline come through. Like, just crazy. We didn't have the money nor the conviction, to be very honest. But I actually asked somebody, what's a good protein bar 5-6 years ago? So my colleague said, Whole Truth is nice, the taste is good. So I bought Whole Truth. I really liked it. It's very chewy, it's an acquired taste. Okay, so finally I acquired the taste, I only eat Whole Truth now. So from my lens, I then went and looked at his journey. He's that obsessive guy. His labeling. You talked about an honest brand, you should see how honest that brand is. Right? Everything about packaging, the literature, what comes in the package, the YouTube, everything is honest about it, right? He's winning on that honesty. First 3-4 years he was crawling. He was selling these chewy, yucky bars which stick all around your teeth. Not 90% of the people don't like that feeling, whatever. It's growing, it's not bad. Matrix put money, somebody else put money, it's scaled. It's reached, I think, some 50-60 crore ARR. So even at that point, if you look back and said, was this a great bet? I actually don't know. Okay? Now what's happened? It's a protein wave in this country. Right? Most vegetarians don't get enough protein. Okay? Most people want to be fit. They want to consume even more protein. Not enough people might like the bar, but protein powder works. Right? So 1mg and some of these brands are doing very, very well. So he, with that same honesty, now starts selling protein powder. From what I heard recently, he's doing 40-50 crores a month. 75% of this is just the powder. It didn't exist in the portfolio till a year or two ago, right? So you have to also evolve to that. You can't say, "नहीं नहीं मैं powder नहीं बनाऊंगा, मेरा बार ही महान है." Market गया ना उस direction में. So you have to follow the market, follow the customer. What do they want? So 80% of your revenue now is something they want. Ultrahuman originally was an app when he pitched me. Second time founder, my founder. Obviously I love him. He sold the business to Zomato, made me money. So obviously I'm going to give him some money. He said he's selling a fitness app. He was getting Kipchoge, the world marathon, this thing, all on that. He was going to build a high-profile app, global app. Loved the idea. Then realized that all the app stuff is great, but nobody's going to pay more than $100 a year. So if you want to be a 100 million business, you have to get 1 million customers, right? And the stickiness on apps is relatively low. What do people on apps want to see? You want to see indicators, not just see videos. So then he started tracking all the biomarker advances that were happening. This was actually an acquisition out of Indian Institute of Science of a 2-member team, which became the Ring. Right? He went and got some of the product, licensed it, and started doing the patch, the CGM patch. Suddenly you started getting more body indicators. Today is $100+ million of revenue. The app hardly makes any money. That was my point. To your question, the obsession was around how do you build a great health tracker for yourself. But you realize that's not an app keeping some cool stats off the Apple Watch or the Apple phone. But it's about building your own biomarkers as far more margin. And it's a naked market where Aura was winning it and had zero competition. So just to keep perspective, 300, like I've drifted a little bit, 300 million watches, smartwatches sell, 3 million smart rings sell in the world. Look at the upside. So today 90% of our revenue comes from the rings. 6 years journey, right? So these are real examples of how you got to shift with the market. The problem statement has not changed. That's the fascinating part. You've expanded the SAM, TAM, TOM, whatever song of the problem set. That will not happen unless you're obsessed about some part of the problem and you entered the market. You can't just simply be a ringside spectator or dream up this number or like not, just be an armchair critic from a VC perspective and say, "Ho hi nahi sakta," right? And by the way, if protein powders had not taken off in India, maybe it would have taken 4 or 5 more years to compound to that scale. That also can happen, right? And so on and so forth.
I just had one more question. That you told that there's some founders in your portfolio which basically have people never worked in any company and are student founders. So how do you see their credibility basically? So if I'm a student.
So somebody told me from Grad Capital, this guy Abhishek Sethi, Bits Pilani guy, who started the fund, he told me something interesting which I hadn't articulated better than he did for me. He's young, he's like some 20s, late 20s. He started Grad Capital. He said, I asked him, how do you judge? Because he's actually looking at them every day. Right? Some of the plays we made were like in the early days. And we didn't know better. And we were cutting 1 crore checks. Very different risk from writing 20 crore checks. Right? So we took a punt, to be honest. It looked like a great idea. It looked like this guy had vision and courage to be able to go conquer the world. We cut the check. And then some didn't work, some worked. So how do you make data points? I asked him, you look at these guys every day. So he said he actually had a chance to invest in Appalachia, but something happened. So he said, he used him as an example. He said, I spoke to him 5-6 times in like a 2-3 month period. And every time I would meet him, it was meeting like a new guy. He had absorbed, learned, and evolved so rapidly that it surprised me. In that is not a lesson for a student entrepreneur. In that is a lesson for all of venture scale entrepreneurship. Not regular entrepreneurship. You can be a lala behind a counter for 50 years, make cash flow, be very happy in life. I have no problem with it. You're not venture fundable. Venture fundable entrepreneurship is basically your ability to keep evolving as the self-appointed CEO on day one. Who the hell gave you the title CEO? Are you worthy of a CEO? Whether you're 35 or whether you're 21, it doesn't matter. You're not a CEO. You just called yourself CEO. Spelling ke alawa, you don't know anything else. Everything else is learning on the journey. Right? So learning and just rising up to the challenge every time is the superpower. And for that, you will not find it at a point in time. As Benjamin Graham said, in all investing, you never invest in a dot, you always invest in a line. At best, you can accelerate the journey of the line. Meet him 6 times in 6 weeks. That's the line. Because you can't wait for 6 years or 6 months like in a stock. So you try to learn faster about the person and see whether they're learning even faster than you. So most people say, and we had a version of it. You know, we would sometimes, in our early days, the guy would come pitch us, would say, we can help you. We don't know whether we'll write the check, but let's help you. And we would make 5 introductions or 4 introductions. How they dealt with the introductions gave us courage on whether to invest in them or not. They would just literally barge open. Like you just give them a finger and they'll barge open through the door. Fundamentally, that's entrepreneurship, my friend. Everything else will figure itself out. You're all smart people, crack JE, sitting here. How do I differentiate on intelligence? Right? Your circumstance should lead you. You should be determined enough. Like, and so a lot of people who meet me after the Nikhil Kamath podcast say that the one takeaway for them was how I held Narayan Murthy's door. I was desperate. I'm an entrepreneur. I would never do it in normal circumstances. Right? Entrepreneurship will push you to your limits of like discomfort. That's what it is.
Mostly congratulations on your fund.
Thank you.
Shares. We are a music tech startup incubator at the Hyderabad. So I have a question on consumer internet specifically. So how are you looking at this space now when the internet users are evolving, companies are evolving, especially in media and entertainment space?
I think it's sadly historically. By the way, we funded a lot of things which we dreamt could be audio first consumer startups. All of them failed. Okay. And then post the pandemic, I think we're seeing some action originally in Cuckoo FM, Pocket FM, etc. And I was surprised that somebody's listening or paying for this. It turns out most of it was global audiences. Indians don't pay, right? And it's just the nature of Indians don't pay very well for media, right? And when you go to a movie theater, you pay a little bit more nowadays, but you pay because it's a fun experience with friends, girlfriend, family, whatever it may be, boyfriend. But you don't pay for watching that content for 800 rupees or 400 rupees. So that's the challenge in India. I think you have to have a compelling enough service that I think converts itself to a subscription service. That's what's worked in India, right? And can that scale to millions of users? And a lot of people said when we invested in Stage in one of our companies, they said, who'll pay 400, 500 bucks for Haryanvi content? But it's working. We have 1.5 million, 2 million subs right now, right? And I think you have to prove to yourself and to the investor that you actually have enough of an audience who wants this content badly enough. Of course, UPI autopay made it a little easier, but it's also being abused because once you sign on, it's easy. Not too many people are educated to get off it. So I hear rumors that RBI is going to clamp down on it because not that anyone's cheating anybody, but it's just lack of knowledge about this will create bad incentives. And so you have to think about, and before UPI autopay, it was much tougher to build these businesses. Now there's short form content, there's micro dramas, there's all of this nonsense that's working. A lot of these guys are pivoted to that. They're not even building the original stuff that they started. Same thing, it's like that Whole Truth guy who's now selling protein powder, not the bars. Right? And so you have to think about where the market is and move to that direction. But that also is it has its own risks. That's a crowded space. 8 or 10 companies are being funded. Why are you better? Why can you? So this is the problem. When you don't have a moat and you become a commodity yourself. That's the risk.
Just a short follow-up.
Yeah.
We had like RMG ban now.
Yeah.
So like how are you building theses around gaming now?
We've never been an RMG fan. I think fundamentally, I feel in India, my biggest problem is, in that way, I'm at heart an impact investor.
Blume rolled out one report on gaming also.
Gaming, yeah, we broadly think about as a like a need, an entertainment need. So we did roll it out, but we haven't made too many bets. And if Karan was not a repeat founder of ours from an academy, I wouldn't have been a backed Light Fury, right? So there are certain reasons why we do certain deals, right? But am I going and chasing them? No, I'm not. And am I looking for there? Again, I feel there have been plays in India like Ludo King has made shitloads of money, and with no backing, right? So you can build cash flow positive businesses of that nature. We backed MacMocha, we did RoloQ, we did HashQ. None of them worked. So it's okay. I mean, we tried. Maybe those biases linger. So what happens when you have a bias of a lot of failures in ideas that you've tried is the bar keeps getting higher every time. That's all.
Hi sir, my name is Samay, and I'm interested in your journey in the sustainability space. Since this comes from somewhere, how Blume invested in Carbon Clean 14 years ago, especially in a business which was B2B. How do you see that 15 years later now it's doing so good, and 10 years later, where do you see the market going in this space? As you were talking, as a VC, you always see.
Yeah, the issue with sustainability is it's geopolitical in its end state agenda, right? It changes with local governments, global geopolitics. Like right now, the American funds are again struggling because Trump says, "I don't care about it," right? Capital sources go on and off on this. So how do you actually build a business that is sustainable in the sustainability space is a non-trivial challenge. So you have to have, like for example, if I price my EV at twice the price, the customer will say, "What sustainability? I don't care," right? If the total cost of vehicle of a Tesla is much lower than a similar luxury car, even the luxury guy will not buy it. It's a US market where Hollywood guys will buy it and drive into the red carpet because they want to make a statement. In India, that statement is like 0.5% of people who are rich enough to say, "I own a Tesla." The other 99% of the people who buy like a Tesla will buy it because it makes commercial sense. So whether that's a farmer, whether it's somebody who's getting educated for a job, whether it is somebody who's borrowing capital to build a small farmer or a small business, all of them will not. Sustainability is not only around climate, right? It is about all of these are a feeder into that value chain, right? All of farming is sustainability. It's about sustainability, right? So I feel like the technology or the business model cannot just be cool for the sake of. In Carbon Clean, we could have died half a dozen times, right? Because somebody didn't give the money or the politics did not move in that direction. We had to uplift the entire company and put it in the UK because no one cared about it in India. Right? So please think through how many turns of luck something has to go through to make this happen. So it's not straightforward in that sense. So as an entrepreneur, you want to calculate all these odds before getting into a space like that. That's all I'm saying. Today we have a company called Nico Robotics. They want to solve for manual weeding in India. Okay, so they said they'll do spot spraying with computer vision technology. How much will an Indian farmer be able to pay? What is the value chain of delivering to that farmer? How do you get a distributor to distribute it, maintain it? We have a small farm problem in this country. It's a much more sustainable way of actually growing crops and human labor, better use of human labor. It didn't work. It's not scaling in India. Guess where it's scaling? Lettuce farming in US. So do I have a strong philosophical problem with it? Absolutely not. So as much as I'm speaking in a Hult ambit today, I'm not that impractical that I obsess about it because I'm not an impact investor by DNA. Like by definition. I'm an impact investor by DNA. I love the problem when he pitched it to me. But he's for his self-sustenance says I have to build it in the United States. I'm saying please do it. Right? So same thing, we're solving for big emission problems, but globally, because India is not a deep enough market for Carbon Clean to come and sell those solutions at $1 pricing in India. Nobody wants to put up that kind of investment. It's a $40 million plant. How many guys in India care about sustainability enough to put a $40 million plant to capture flue gases? Right? So I'm saying it's not, so that's why we have a wide spectrum of stuff. Will we take those bets? Yeah, we do. We're believers that these are all better for the betterment of the planet, and so we will take those bets. But will I bet 100% of my capital on them? No, absolutely not. So we try to take a measured approach that we're getting 20-25% of our exposure in every cycle into such bets. But it's not like I'm obsessed for that reason. I just feel when you keep your radars open and because you've showcased enough success stories in that space, more come to you and pitch to you.
But sir, if not right now, 5 years down the lane, are we seeing this accelerating at a very high pace? Or
What is
the
accelerating?
sustainability space in the VC ecosystem? Or is it the West that's going to take off more?
Even the West has failed on this. Green financing has failed multiple times in equity. Either it takes too long or it is not sustainable on the business model side. You have to have both. You're not building charitable businesses. No one cares about that. You're not building not-for-profits. And you don't attract the crowd. Please understand that That's what I'm saying. Venture-backed entrepreneurship has a certain DNA attached to it. You tell me you're generating 2% return, why would I care? I might care. My LP doesn't care. My investor doesn't care. He didn't fund me for that, sadly. So if I get money from charitable foundations who only care about sustainability, it's possible. There are certain impact funds, like Omnivore is only agri, rural, climate. What's the other one? Started recently. It's also climate. So there are funds of that nature. They might get investors who are willing to live with lesser returns and more sustainability focus. For me, honestly, my investor base doesn't care. So I try to balance that portfolio, which I think can actually scale to venture-like returns within the sustainable space. If I find it too exotic or too far removed from the reality of making $1 billion business at high margin, I'm not interested.
So when you said about market that you give 40% weightage, but when it is about people say about market creation like in Zepto or technology type, then how market comes into play? Like won't the evaluation be different?
Fundamentally, they're going to solve an end state problem which is about the same, right? So if you can't imagine it, that is why most of these businesses, like if you look at Airbnb, it's an easy example, since all of you will at some point use an equivalent of an Airbnb if you already haven't, probably got rejected by 48 out of 50 VCs. So what you folks don't seem to understand is that just because it became a large company, everybody believed it all along the way. That's never true. Just the rule of thumb, just whether you want to believe it or not, rule of thumb is every round, 48 out of 50 VCs say no to every company. Every company. Could be because of price, it could be because of risks, it could be because of the entrepreneur. For whatever reason, they say no. Okay? So, those are the odds. So, what does it mean? That are the 48 people dumb people? They couldn't envision the market opportunity being the same size. Maybe 20 didn't like the founder, 20 didn't like the market, and 8 thought, even if I fund, there's nothing going to happen to this company. That's it. That's the makeup. Somebody might have believed the market, but they might not have thought like 2 school kids can build Zepto at 19 and 20. Could have been, right? So what are the reasons? How does it matter? Only end state ends, not justify, but explain the means. Like, meaning, if only 2 guys said yes, there must be a reason why the other 48 said no, but you can keep mining it, how does it matter as well? Only 2 guys got it, right? So market definitions, so the other way to answer the question is, it's not like Zepto is like creating, the only companies that defy that logic that you said is absolutely new behavior. All social media was absolute new behavior. So it took away dollars, ad dollars, and eyeball time, attention time, away from some other medium. So they're creating new markets, but it's always substitution. You don't have a 25th hour in the day to doom scroll on Insta. It's coming out of your television time, right? And your internet reading time is coming out of newspaper time. So you kill 2 industries along the way. That's the play. That's the play. It's not like it's mythical that it's coming from somewhere else. Similarly, just because Zepto is born, somebody's not consuming twice as much at home. Same baat. Wahi baat hai, everything. If I'm having protein, I can't eat like the junk for that same next 2 hours. No? I've eaten somebody else's lunch. That's why the protein guy is growing fast and some junk food guy is not growing as fast. Apples to apples. Maybe the junk food guy is also growing because more consumption population has arrived to eat more junk. The point is, you get my broader point, right? I'm not eating as much junk because I'm eating those bloody protein bars, right? And I'm paying a premium for them. $130 a bar, right? So, those are always trade-offs. So you have to not believing that there is a no end monetization. You have to make a leap of faith on what it's going to substitute. Right? So quick commerce is a substitute for regular commerce. So did you believe this many people will actually order into like their doorstep all day, all month? Nobody believed it until it happened. By the way, it doesn't work as well in the US because the guy will come to your door and he expects a tip and there's a service charge and this and that, and you say, shit, I just ordered like 2 bottles of Coke and like this was $8. Makes no sense. In India, you order 2 cans of Coke, it falls short of the 200, you add another 40 rupee item, you get it for free. And the math somehow works because for every delivery guy who skips out of Zepto and Blinkit, there's another guy, poor guy who's come on the train yesterday from some village who'll take that 15,000, 18,000 rupee job. There's no inflation in quick commerce service delivery guys' wages, sadly. We have an exhaustible supply of 18, 20,000 rupee people because we don't create enough jobs in other markets. So it's peculiarly Indian, my friend. Could you have imagined that that could have happened? Very tough. Very tough. Any more questions? I'll do the mock cases and come back. 1, 2, 3, 4, 5. Let me just do the mock case and come back. That's what you want me to do. Right? So let me do that. This is on the same deck?
Yes, sir. Go back.
Okay.
We can start with this. Reset.
All good, all good. Can somebody give me some water? And it's hotter than I imagined, so I'll take the jacket off. Yes, you take a minute to read the slide, or have they all read the slide? Have they read the slide? Yeah, then you have to read the slide. I'm not going to read it for you. So, what all was I supposed to cover? You wanted me to dissect it in 3-4 ways. Just remind me.
So just basically, we want to have your opinion on this startup.
In what variables? You had something written. I forget. You remember it, Harsh? Harsh is my colleague from the firm. Helps me in a bunch of stuff.
VC perspective, what works, what doesn't, red flags, green flags, investment decision and
What was the last one?
investment decision.
Innocent decision. So, if you, to your question, multiple questions that were asked, do you sense a sense of uniqueness around it? Right? It's a marketplace of agri-commodities or agri-goods or agri-inputs or whatever it may be. Invariably, somebody will come and pitch and will say, I'll only do agri-commodities, sir. It's a fake pitch because the customer will say, I want inputs, I want tools, I want like tractor parts. Invariably, you'll have to broaden the entire scope of this. It's like how Amazon and Flipkart started by selling books. Of course, they don't sell only books. The customer doesn't care whether you sell books. I want everything, right? And quick commerce on day one went to like 2,000 SKUs. So this is the same. If you understand the commerce market, everything that the farmer needs has to be on one platform. Second, can you make enough money being a pure marketplace? Are there enough margins in a low margin, broadly commoditized space? What is the value that the farmer gets that you can't get elsewhere? Is it speed? Is it convenience? Is it price? Tough to know. Third, will you build private label products which give you higher margins than relying on other businesses, which is why Zepto started Cafe, Blinkit hasn't yet started, moved to inventory model, etc., etc. Big Basket has its own private label, so does Reliance, so does DMart, etc. Right? So, can you do that in the agri space? That'll be my thinking. Right? So this is my framing of the problem. Are you solving an impactful social problem? Of course you are. Right? Because the farmer has to travel distance. Why do like beauty product companies and shoes, etc., will take off in the northeast corner? Because nobody goes and sets up stores there. They think it's too small a market. You put it on an e-commerce platform, it becomes a very attractive market. Because you just have to ship it there, you don't have to open a store. And they need the products, so they will order it. So if you go to the hinterland and you basically offer all of this within 24, 48 hours of service delivery, you will like it, right? So that's, you're waiting for me, something?
We have to give you a memento after the session. So
Don't worry about the memento.
no,
No, no, we
Or
have
it's coming quick.
we have some more time. That's all. So and so then he's saying, I will set up franchises. So you have a quality problem, right? If you have franchises. So can you control quality? Can you control standard operating processes which allow for this to become an offline plus online hybrid store? I have no idea actually. So when I'm looking at this, I will judge whether these two gentlemen or this woman and guy or two women have the ability to actually chops to build an operationally intensive business of this nature. If I don't get that conviction, I won't play. That's what so there's also a thing called this product market fit and this founder market fit. Right? If you have no exposure to rural India and you came out of this classroom and said you're going to do this, with all my biases fully disclosed, I will not fund it. I'm not funding the journey of your discovery of all of that on your own. But if you've actually spent the time for whatever reason, you worked with Marico for 2 years, that was your, rural distribution was your internship, you went there, you fell in love with this rural problem, you sold that story to me sold that story well to me, I might give you that one. Right? So, I think the asks in all of these examples are kind of okay. Fundamentally, if the ask is too high, it tells me that you have no notion of how much risk the business has and why are you asking me to commit too many dollars to the risk. I would love to see what this 6 crores will be spent for, and in my feedback to somebody like this would be, hey, I believe that you both can actually pull this off. What will it take for you to show this at a pilot operation at a single district? Because these are also geographic intensive. You can't open one in Meerut and one in Nasik and one in Trichy. Makes no sense. You essentially will build geographic density, like how Zepto did or Blinkit did. You got to be able to wow a particular local market, and that's where the economies of scale and scope will emerge. So basically, until I see proof of that, I'm not cutting a check, right? So I might say, what does it take to crack a district for me? Yes, it's 2 crores will do. I say, go raise 2 crores. And raise it from a bunch of angels, or raise it from an impact fund. And then come back to me with the proof points on that, and then I will see whether I want to cut a check. That will be my answer to this. These, I know they've tried hard, put some deck, put some comparables. Comparables make no sense in early stage. Comparables only make sense to the extent of your ability to visualize how large this business can be and what the business model can be. So you say, oh, somebody has built to 500 crores in this and can continues to grow at 20% and they can actually make 12% EBITDA. Let me look at that business and see whether I can question this particular company on whether they're also able to build in the same fashion. That's it. Right? The math on trying to compare the two and put a valuation metric is stupid. So there's bottoms-up math. You look at the quality of founders, you look at what they've built so far, and you have a baseline of how much value you're willing to pay. That's what a lot of us do as VCs. There's what's called top-down math. Top-down math is, I give the guy 6 crores, how big a business is he going to build? He said he'll build 20 crore GMV. I think he's going to build 10 crore GMV. At 10 to 20 crore GMV, he might get valued at 40 to 50 crores. So if he's going to get valued at 40 to 50 crores in the next round, pre-money, I'm not paying more than 15 crore post. You say, really? Is that how you value companies? And I say, yeah. That's how we value it. Right? So it's an art, it's a science. There's bottom-up math, there's top-down math, there's risk math. He wouldn't want to dilute more than 20-25% of his company for that raise. I wouldn't want to own more than that. I don't want to run the business. I want to give enough room for dilution in the next round. So if I invest, I won't pick up more than 20% of the company. 20% on 6 crores is 30 crores. I think it's too rich. I will tell him take 4 crores and give him a 15 crore valuation. I mean, you all have seen some episode of Shark Tank, I presume. They're also doing this mental math in their head and figuring out what's right, what's wrong. Because they've seen enough examples of this. Same thing with us. It's a heuristic. It's not like we feed it into an Excel sheet. You broadly know, like if you ask 5 of our partners blind tested on what the valuation should be and how much you should own and how much money you should put, all of us will have an answer within 20% range. 20%. So, sorry, this was already power tech. Yeah, so someone said, like, I will try to figure this out, whether this is proven, whether there are efficiencies or it's just a tall scientific claim out of a lab. Like in Carbon Clean, that was the problem. It was a scientific claim of a lab. The classic challenge, nobody believes it. Forget about me, the customer doesn't believe it. Then you got to go show this in a bigger lab in Netherlands, show that proof. Who's going to put like $20 million of expense on some lab idea? Right, so you keep testing it. So where they got lucky was the British government was giving grants for carbon capture. Somebody told us about the program. We tied up with some British company, bid for it, got the second largest grant, £3 million or so. We got £1 million to expand that in a test plant at industrial scale. Then you show those results and then you get your first commercial. What are the odds of this stuff happening? And this is somebody who had walked into my annual day and said, oh, this looks interesting, I know something is happening in the UK government. If that hadn't happened, that company would have died by 13, max 14. Right? So this is how this works. So if you bring me some tech like this with no proof points, I'm not cutting a check. That's my VC view, however small the round might be. And this is exactly kind of similar to what I said. I would love to see, how this is operating at pilot scale, whether it's scalable, whether this team has the ability to go and implement multiple projects of this nature. What is the commercial benefit of this once it's implemented? Have to test some of these things. Because these are not easy to benchmark. It's not like there are 18 companies like this, right, in the market. Yeah, this has given me some examples of this, but again, if there are examples, yeah, there are examples, but then you always wonder, why can't the big guy do it better? Why can't the incumbents do it better? So if he's bringing me a novel tech, I'm willing to take a bet, but if the biggest companies are this small, I'm not going to cut a check. So my assessment of how much of that he's able to capture in terms of revenue is what's going to prompt me to play that. So sadly, the examples that are being used here are great for a Hult Prize candidate, but Blume would. By the way, I get pitches like this all day. Unfortunately, sadly, my single line response is it's too early for us. I don't even explain myself anymore on that. It's just too early for us. I'm not your right investor. Go figure out somebody else who cut that check. The version of Blume that used to write this check is 15 years old. This math doesn't make sense for me. I won't be able to write this check. The last example is even worse. It's 1.5 crores. So I'm the bad example. But let's say I was wearing my angel hat and I had to simulate this. Basically, I feel it's too little money to run this business viable. I actually have a contra view here. You're raising, I believe in the idea. What is the hottest fund for company? Battery Smart. In her portfolio right now. But he raised millions of dollars upfront. I skipped around, came in later after he had set up enough swapping stations. We did not, these are flaws in this. I saw something here which is a flaw. Yeah. Raising money to be used primarily for fleet retrofitting. In my opinion, terrible idea. Right? You don't want to change the way the world works. You have enough problems on your hand. Right? Simply solve for who's going to come in, and unless you believe that only by retrofitting will the world go to electric. If that's the bet, maybe. I don't believe in it, so I won't have bet on it. Right? That's like saying there is a market to retrofit every four-wheeler into electric first. This thing. So all of us will then go to this repair station and start retrofitting our cars into electric. I'll never believe a business model. So it's a bet against human nature that people will actually do this. Why do you think Battery Smart's working? Basically, you're able to give two-wheelers and three-wheelers at half the cost today in the market. So the biggest customer for Battery Smart are B2B two-wheelers, because it's a commodity and you want to reduce the cost of operation, and passenger three-wheelers. The e-rickshaws that you see all across North India are basically our biggest market, because by not buying the batteries, the cost of the rickshaws come down by 50%. Right? And so you're catering to a existing need and spurring demand where a cost structure of buying the batteries would have actually made the market grow slower. by having a battery swapping opportunity, the market is actually growing faster. And you're taking away the charging load from the rickshaw driver. Because fundamentally, I've seen those stations, you should see them whenever you go. You should just go and peek whenever you see a battery smart charging station. You go there and there'll be 4 guys lined up. The guy takes his 2 batteries, opens the lid, takes 2 batteries, puts them in there, scan the QR code so you know which batteries have been returned. He picks up 2 more, you scan the QR code, he puts them back. It's a daily subscription charge or a monthly subscription plan. He can swap as many times as he wants, and then he's off. He's not stressing about actually charging the battery. It's pre-charged. So it's like going to a gas station even faster than a CNG station, right? And the other guy, there's one person manning the store, and it's a franchise operation. You don't need employees in that. You give a percentage of that cut to the guy who's running the store. That's it. In a classroom of this size, you can fit about 6 battery smart stations, each doing 150 batteries, charging at the same time. Anyway, so that's the case studies. Back to questions. How much time do you guys have? I know you asked for a lot of time and I gave less, but we can stop at 7:30 if that's okay. That's good?
Yeah.
Okay, 15 more minutes for all of your questions. Yeah.
Yeah. At Blume, you guys have backed a lot of hardware-heavy startups. Do you see the climate hardware startups scaling as much as, say, regular consumer or maybe even SaaS?
Give an example.
Of the startups you've backed, or example of?
Climate. What do you say? Climate hardware stuff. What do you mean by that?
Yeah, so let's say someone making an air purifier.
Yeah, why not? Yeah. Consumer or industrial, it can work. Of course it can work.
To the level of general consumer, let's say a protein bar.
Sorry?
Let's say whole truth.
Yeah.
The scalability, would you see climate hardware reaching that
I mean,
level?
Attenberg is now on profitable and path to public company. They started building some motors and is it an IIT Bombay startup? I can't remember. Yeah. It's like same with Sedimac, same with IdeaForge.
Right.
These are all IIT Bombay startups, guys.
Right.
Yeah, one's public, one's going public, one's on the verge of building to public. They all got funded not now, a decade ago.
Right.
Well, so where's the question? They can be.
All right.
So it doesn't matter. I don't think it's about climate, non-climate. That's what I'm saying. I know I'm sitting in an arena where you guys want to know more about sustainability. But to most VCs, that's a second order problem.
Right.
I want to believe in the fact that this is a standalone, scalable business.
All right.
The wrapper is a lovely add-on. That can't be the chocolate. Chocolate is like, this is a wrapper for me. So if it makes sense, I'll invest.
All right.
Yeah, agri robotics, who does in this country? I've done one, no?
Yeah.
Okay. Warehouse robotics, who does? I did.
Right.
I've done 2, I've done 3. So we're doing industrial, we're doing impact oriented, we're doing climate, we're doing energy efficiency,
Right.
whatever we can. We've looked at meters, we've looked at a whole bunch of stuff. Some of them don't pass that muster. And honestly, you might show me 25 great ideas in a year on that space. I will do 2. Because I also want to do 2 in fintech. I also want to do 2 in consumer. I also want to do 2 in cross-border AI. So I want to distribute my risk.
Right.
So 2 of the 25 get funded. That doesn't mean the 23 are bad. It's my choice, that's all I'm saying.
Makes sense.
Some other VC might fund 2 more. Some other VC might fund 2 more. Suddenly you have 10, 12 of these in a year.
Sure.
If they become 4 or 5 of them become billion-dollar companies, I can assure you more people will come and put more money. Because a lot of humanity is pattern matching and FOMO, and has there been a precedent? It's exactly how stock markets work, right? And so that's the public market for a reason.
Right.
You come to a private market which is even more exotic and requires even more conviction. Chances of that happening are much lower. You have to have deep conviction to make those bets.
As you mentioned about Aadit 2 to 3 times, and Zepto recently raised 450 million. So as an Indian VC, what do you think about QuickCom in India? And with this also one more question,
It's worked. I mean, we were the first to check in Dunzo. After 5 pivots, it became quick commerce.
Okay.
But then we had exhausted too much capital, and somebody, 2 big, 3, 4, 5 big funded guys came and killed us, and we went to zero.
Okay.
So obviously, I'm a believer. So what is there not to believe?
But
You asked me a philosophical view on quick
no,
commerce.
the question was like in India itself, what do you think are the future opportunities for which this much money is flowing in?
Oh, that way. No, right now I think consumer brands are still getting a lot of love. Whether that is retail, whether it's a combination of marketplaces, whether it's own brands, private labels, new categories. We backed a lab-grown diamond brand recently. We think that's the quick commerce of the jewelry space, right? What somebody might be spending 10 lakhs on as like wedding jewelry today, you can get like a legit diamond and you can buy 10 of those pieces for 10 lakhs. So we believe consumption will just explode because now suddenly you're able to afford that. That's our view, right? We backed, so whoever talked about baby products, we backed a quick commerce play only in baby products. We think it's a very peculiar mother behavior, young mother behavior at home, which will drive a different category, which Blinkit and Swiggy will not be able to solve, Instamart will not be able to solve very well, etc. So it's a bet. Do you think that's an end state bet of just doing commerce as a platform? No, we think we'll get into private labels, we'll do other stuff, we'll do sustainable brands perhaps, depending on what the customer is looking for. Because it's something you put on inside or outside the child, so they're even more sensitive. There's an opportunity to go create a new set of brands. And we think baby OS is too old and big to be able to compete with us on quick commerce. Just like Big Basket or Reliance or DMart are struggling against quick commerce. So that's our view.
And just one more question, like what do VCs actually think about the creators, like the influencers or creators who turned into entrepreneurs?
There's a market for it. I think some guys back platforms where multiple creators can come of this nature and you get a cut of that revenue. Some people, standalone brands can become, like a Deepika can make an 82 East very large brand by simply being an influencer. This is nothing, this all still sits on the consumer spectrum. It's not about one or the other. You have to believe that a $1 billion brand can be built. Kylie Jenner built it, can Deepika build it? That's the bet you have to make in India. I didn't answer the other part of the question. I think there is a lot of room for fintech. I feel if you're going to become a $10 trillion economy, there'll be boatloads of great fintech companies which get you there. I don't think the legacy has a right to win all of that market share. The legacy companies and legacy banks and legacy brokerages. You can innovate, and you can build a lot of interesting fintech companies. So there'll be money going to fintech, consumer. We think AI / will replace conventional software, and all of deep tech is an open territory. But in the second half of the bucket, I think if you don't think of yourself as a global player, other than maybe in electric vehicles, which is a local play, we don't think it's a large enough market to be building and selling in India. So this is how we operate our portfolio. So I'm obviously speaking from my lens. I can't speak for the market, but this is what we believe in. We've believed in it for 10 years. We allocate about 20 to 30% capital into all of those buckets. So that's why we're generalists. We play everything, boss. We're not like so obsessed about one thing or the other. And we try to ensure that we find 2-3 great companies in each of these buckets every year. That's our playbook.
Okay, so hi, I'm Karam. All of us talked a lot about how the market is very important for the startup. Right? The startup might work in India, but sometimes it might not, and sometimes it might work in some other place. Is it like the same for VC funds? Because VC funds in India, something works for a VC fund in India, but something in the West might not work for them in the same way.
Yeah.
How do these funds differ by geography?
Yeah, I think, so for example, you don't have a right to go and play into the hottest AI companies in the US. So if a fund in the US is raising $1 billion, it has the ability to deploy and build $10 billion companies very quickly. So there's an AI frenzy in the US. Can you replicate that in India? Tough to. If you have a US fund, they can play into the consumer wave in the US, but is there as much depth and growth in the consumer segment in the US? Probably not. At some point, all of you go to the US, you walk into a grocery store and it's a fascinating experience, right? You will find some 57 varieties of dahi. Right? How will you differentiate the 58th one? Right? The same guy, Danone will have fruits, protein, this, light, fat-free, fat mode, everything. Right? So very difficult to penetrate on consumer there. Therefore, it's a different market. There's probably more of an opportunity here. Same thing with fintech, right? They're very set in their ways, right? And they don't have UPI rails. They don't have ease of transaction costs. Every time I send, like, I have some investment that I have to make there. Charge me $15 for a wire transfer. And again, what the hell is going on? But that's the US for you. They don't change their ways. Can someone disrupt them? Yeah, they can, right? But much tougher, far more regulated, far more arcane. So it depends on where you think you can actually disrupt. And they will focus on those sectors, and they're always chasing the hottest sector, the hottest deep tech sector, etc. So they build fund sizes and speed and velocity for that. I don't think, can afford to play those games. We have to build sustainable public market companies, and you have to look at the public companies. You have to look at the scale of what you've built, what has gotten built in India, and say that that's your imaginable limit. Today, the fact that Lenskart is bigger than most consumer companies is a surprise to most people. Zomato is a surprise to most people. Until you build that, you don't know. You can't design a fund to say, ek Zomato aayega mere fund. I have not seen a company greater than $1-2 billion in my portfolio yet. If you tell me, dream up of a $7 billion company in the next fund and therefore build a fund for that, you can't. Right? So that's how you model funds, and therefore you invest very differently. Size of outcome that you can project is very different. India versus the US. In the US, people can imagine $10-20 billion outcomes. In India, it's literally you can count them off on one hand. So you got to modulate your funds and your investment strategy accordingly. And then who invests after you is also important. And we're not an M&A market. There, LinkedIn got purchased for $8 billion. If you build a LinkedIn in India, could it got purchased for $8 billion? Unlike none of the big IT services companies have ever bloody bought an Indian product company. So who will buy the company? Right? So these are the problems. Sorry. Last few questions. Yeah.
My question was about the tech sector, mostly about the hyper AI integration in the sector. So in the past year, we saw that the large cap companies are being forced with marginal pressures and they are forced to reduce their prices. And we see that the emerging IT companies are able to adapt to this AI integration much faster because their business model revolves around it. So do you think we'll see a shift in the market in the top positions, or what is your opinion about the tech space?
Top positions of the services companies.
The export, IT service export companies, or the...
I don't have a firm view. I just feel they're being very slow and losing advantage today because they feel they can adapt faster than buying companies or buying tech or adapting to the tech. Broadly, the market feedback I get, I'm not an expert in what the services companies are doing. The broad feedback I get is that they're much slower than they should be to leverage, their adoption of AI. But you're seeing layoffs, etc., because I'm sure they are doing a good job of adopting. But is it fast enough? Are they disruptive enough? In most of their businesses, are they going to get disrupted? We don't know. See, the IT services companies, legacy systems are not easy to kill overnight. So they will have a trail revenue which will run for another decade, is my take. But can they win new revenue is the question. So I don't think they'll be dead in the next 2, 3, 4 years. I think but if they don't adapt, they will have a slow death in the next 10 years, is my take. But very difficult to know. I don't sit inside. I don't have a view per se. And I'm also not playing the game of like what they are, which is a $50 billion company. I'm desperately trying to see how quickly my companies can get to 100 million of revenue, $1 billion of valuation. And after that, I'll think about should they get acquired, are they my competition, etc. Today, for most product companies in our portfolio, they're not competition per se. They're like partners at best. So I don't have a very strong. But as I said, market feedback is that Indian services companies are moving very slow relative to what they should be doing with the AI wave.
So why there are very high numbers of unicorns in fintech versus anything? Like, then I ask you this: why fintech dominates so much in numbers?
Basically, financial services are like a gatekeeping industry any which way. It sits in between every transaction. So this flow of money without which the economy doesn't move, there's always a financial service company sitting in the middle of it, right? So if money moves 10 times in a day, there's 10 times to make money. Right? So if you're building a $10 trillion economy, the velocity of money and the circulation of money is not going to slow. It's going to only accelerate. So even if it's a very, 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 very thin margin, it's basically the number of transactions that actually allow you to make money is incredibly high in my opinion, right? And if you build, so biggest companies in any economy are banks. BFSI sector is always big in every economy, even in public markets, traditional guys, SBI, whatever, because the spread you can make on money and the income you can make on money is something that the average retail person cannot make directly usually. So there's always a middleman guiding that. It's either a stockbroker, your wealth manager, your banker, or any of those. And the margin spread on the amount of money that they consolidate, you can never do on your own. So it's just a sum total. If you build scale, you will end up making a lot more money, just because money makes money.
So like it would continue, like according.
I always feel it will have a significant market share of value created, and I do think the biggest share of unicorns when we hit 150 profitable companies or public companies, a big chunk of them will always be like traditional economy. Even the new economy will have a significant chunk. It won't be that dominant, but it'll be 25, 30%, 40%. So for example, in India, there was a joke at one point that every e-commerce or every company will become a lending company, right? Even today in Spinny, which is our used car play in our portfolio, Spinny suddenly might have more profitability out of its lending business than its car resale business. Potential. Because people need financing, right? And in an aspirational growing economy, you need financing. In a wealth created economy, even if it's the top 10% of this country, you need to park your wealth, right? And in a consumption economy, there's massive commercial transactions of one kind or the other. A fintech company is sitting in between all of them, right? And the more the transaction friction, the more they ease it, the more money they can charge. So if you need to build a trust layer in between, if you have to do fraud detection, you make some money. Okay? Things like that. And so there's always going to be money sitting in the value chain of money itself, which is why fintech will always do it.
What do you think of exiting any company? I mean, what makes you feel like it's a good position for an exit?
Usually, when your time is up on your own fund. It's a natural exit for that time frame, 10, 12 years. And B, if there is somebody who buys the business, then there is no decision. If it runs out of money, there's no decision. It has to sell, for example. If it goes public, there's very little decision making. You start part selling your ownership. Those are usually the drivers of when to exit. On a fundamental basis, you believe that the company is suddenly taken off, and then it's inevitably going to slow down or it's overvalued, that's a good time to exit. And if you believe that your return expectation is 20-25% for the fund, but your hottest company is driving most of those returns, but it's reached a point where from here on you don't anticipate it growing at 20-25%, you should sell something, if not all. But exitability should exist. Who's going to buy that stock? So it's easy to say that I want to exit, but if nobody's buying it, there is no exit. In Dunzo, nobody ever exited. There was no room to exit. It was a cash machine, right? It was sucking cash. So nobody ever had the chance to sell shares, or the company needed all the money. Okay, we good?
Last question.
The last question, anybody? Who's lucky? Yeah, you.
So what made you invest in Pixel? There's a company by two founders who are new to the...
Just mad ambition, a crazy energy, like discovery of a problem which came out of like a school project. That's what, like in that entire category of founder personas, there is one persona, we used to have a different term for it. They don't know what they don't know. Founder. We call them they don't know what they don't know founder. All of you are in that bucket, right? You don't know what the challenges of building a business are, but you're just crazy enough to pursue that. I first said no, but Sanjay really liked the guy, and we had mentored him at Bits Pilani. I said we have to do it, and the opportunity somehow came back, so we did it. And so he was a top 10 contender in Musk's Hyperloop project, right? So he had the tech chops. Yeah, they had a set of believers. They, to their credit, had discovered that Planet Labs was already a 10-year-old technology, and they're 12-year-old. And these are things like even Nico Robotics, the guys who sell the farming robotics in the US, like, unviable 10 years ago. Pixel unviable 10 years ago. Why are they viable in 2020? Cost of underlying chips and hardware have come down by 90%. Therefore, they're applicable for these kind of applications. You can't build like a ring like this or a chip or an Apple Watch in 2002 because the consumer infrastructure of not having a high-speed data internet or having at a cost which you can afford, which is why India's internet thing exploded after 2016, after Jio. You could have built a lot of stuff before Jio and it wouldn't have worked. Could have built a lot of stuff before UPI and it wouldn't have worked. So fundamentally, when these shifts happen, you got to look at it. The founder is informing you of something dramatic that's happened. And if you believe it, you take the leap of it. That's what it was. Ironically, after us, there was no Indian investor in Pixel for 5 years. Again, the Indians don't believe that this is possible. That some two kids out, even after delivering, the two kids out of like, Bits Pilani were just growing, building satellites. This thing actually flies. It went up on SpaceX's rockets. It actually beams images. Actually, there's a market for it. There's so many belief systems that have to break. And you did it at that juncture. But I'll be honest, if it was not a three-way split of that risk and a $5 million round, even I wouldn't have done it. You hedged. But as they say in venture, you get paid to take such risk. If you don't take that risk, who's going to take that risk on the planet? So that's the summary story of this. The good news is now I think enough people have made money and they're becoming bolder. The Dipinder Goyals, the Binny Bansals, the Sanjeev Bikhchandanis, they're taking risks that even the VCs won't take. They're becoming bolder VCs than we are. Because it's their personal money, it's the corporate money. What is the cost of corporate money? 8%. What is the cost of your personal money? Only the abuses from your spouse. So you can spend when I borrow $300 million from somebody and have to return $1.2 billion on it, that's somebody else's money. So as much as I might think I'm entrepreneurial, I'm super risk averse at many levels because that weight sits on me for 12 years at a time until I return that money. Those guys can run far more quicker. So risk is shifting to them. They're making bolder bets than we are. So I hope I reach that point someday. But today I don't have the money to make those bets on my personal account. So you're a custodian of other people's money. So you have to be very careful. Thank you.
Thank you very much, sir, for your valuable insights and experiences. I believe a lot of us will be leaving this room with new ideas and inspiration and a clearer understanding of how to actually build and sustain a startup. And I would also like to take the time to thank you for taking out your time for us and being here with us today evening. And I would like to invite Professor Ramesh to present you with a memento.
I assume you're the only professor in the room. Thank you. हर एंगल से ले रहे हैं लास्ट इतना भी पॉपुलर थैंक यू Thank you. Thanks, Doctor. I hope you enjoyed it.
Do follow us, guys, on Instagram, LinkedIn, and YouTube.
Yeah, I know. I've been in touch with Oh, is it? Thanks, everyone.